So you talked about in the 40s when they were able to control this, but led to high inflation. If these new facilities lead to inflation continuing to be high and the Fed having to continue to hike rates, is this going to compound the problem?
It can. Some of it's a rate of change, right? So that the
Yeah.
more that they hike rates, the more they are likely to suck money out of banks, well, especially smaller banks, and towards larger banks and towards money markets.
But you say this is providing liquidity. Is the idea of providing liquidity just the idea of continuing this charade that everything's okay in the economy? And it just feels like I remember a long time ago, I did an interview with Giacomo Zucco, and he talked about the problem with the fiat system. It's like a drug. And whenever you're addicted to drugs, you always have to take more and more until you eventually kind of have your crash and you give up, and then you go through the pain of stopping. But if you don't, you have to have more and more and more. Is this not essentially what we're doing? We're continuing to kick the can down the road of all these problems within the financial system.
Yeah, and I think that's the end game of this type of system, that basically when all the debt's at the sovereign level, you're very, very high debt to GDP, it needs ongoing liquidity in order to support that market. And so we saw, for example, last year with the gilt market, they wanted to do QT. They wanted to reduce their balance sheet. I think, they even had a meeting scheduled to, publicly talk about reducing their balance sheet. And then they actually instead had to start buying gilts, because you would have had a cascade. Basically, as they were all discounted, you would have had pensions selling it. And the problem is they're selling it into a market with no buyers. And it just kind of cascade into a collapse. And so they had to come in as a buyer of last resort and reliquify that. In a similar vein, if the Fed just decided, nope, we're going to do nothing, you would get Silicon Valley Bank just spewing these securities into the market. You'd have other banks come in and, basically the yields would rise and other banks would have to sell theirs. And you get this feedback loop of more and more securities being sold into the market until the treasury market breaks. You have a similar thing that happened to gilt. You'd have that happen to US. And so they're kind of in a position where on one hand, they're helping out individual banks, but at the end of the day, what they're helping out is the sovereign bond market.
Right. So this is the reason why we might potentially yo-yo towards hyperinflation, because every round of these issues, they have to print more and more money or provide more and more facilities, some sticking plaster here, a bit of rope there to try and keep the system, the charade going.
Well, yes. I mean, so I'm hesitant to use the word hyperinflation, especially in any near term. I mean, if you go back long, historically, every fiat currency ends with the end of that currency. So in a long enough timeline, sure. But in the near term, I mean, hyperinflation happens generally with a couple key things. One is you usually have liabilities denominated in a currency that you can't print. So in Weimar, it was, say gold-based war reparations. For emerging markets, it's often dollar debts. And basically there ends up being no foreign demand for your currency. And you basically hyperinflate. So you basically need an infinite amount of money printing, or a tremendous amount of money printing in order to hyperinflate, plus no demand for that currency. Okay. The United States is not really in a position where that's likely anytime soon. There's still foreign demand for the currency. There's a lot of debt denominated in the currency globally, and all of that represents demand for it. But instead, it's about just generally longer term waves of recurring inflation. And then the end game, that's where it gets tricky, because there's really no plan to ever stop the fiscal deficits. Debt to GDP is very, very high, and the world's never been in this position before where we have an entirely fiat-based system with debts this high. And especially because it's not due to a war, it's due to accumulated promises over decades. So there's no light switch that can just change it next year. So yeah, I do think we're kind of spiraling towards a fiscal spiral. I don't think it's hyperinflation in sort of the intermediate term. I wouldn't call it that.
Have you gamed out the potential end games?
Well, I mean, I own Bitcoin. So I mean, basically,
that's the lifeboat. So what's the end game if you don't have Bitcoin?
Potentially gold.
Okay.
Real assets. If you own real assets, if you owe fixed rate debt, if you have a house with a 30-year mortgage, if you own high quality equities, if you own gold, if you own commodity exposures, if you own Bitcoin, that's generally the types of answers. And you can, of course, you can reduce the volatility by also owning things like T-bills. You don't have to be 100% in those inflation hedges, those real assets. But it's basically a situation where, in the 1940s, for example, they had to let inflation run hot. Basically, one way to think about it is that when sovereign debt to GDP is over 100%, it's exceedingly unlikely that that's going to be paid back in purchasing power terms, right? And then the question becomes, how is it defaulted on? So if it's an emerging market that debt is in a currency they can't print, they're more likely to just nominally default and restructure and get another recycled loan from the IMF and just, continue that. Whereas if you're a country who can print your own currency, you're very, very unlikely to nominally default. And instead, you're likely to let inflation run higher than those bond yields for a long period of time or in multiple waves of it. And bondholders will get every dollar back or every pound back, but those will be worth less than when they put them in. And what makes this environment challenging is that this debt is not due to a war. It's due to permanent military spending and due to the way we structured entitlements. And those are not things that change quickly. And so I think we could get into a very long period of just recurring inflation, kind of like how in a lot of emerging markets, you just have just long periods of recurring inflation. And in many cases, it doesn't lead to hyperinflation, at least not in any sort of like 5+ year period, but it leads to this sustained problem that just keeps reoccurring.
Well, you've told me and Danny that you think this is the story of the next decade is inflation many times.
Yeah. I think it's recurring. And I think, right now we're in a disinflationary trend. Basically, whenever policymakers are willing to cause a recession, they can get inflation down temporarily. But I think the story of this decade is that whenever they want to have a period of growth, it's probably going to be a period it's basically going to be coincided with a period of inflation.
What do you make of what's happening with the BRICS nations? I read recently that Saudi Arabia is trying to join the BRICS group. Do you believe this is to try and build an alternative to the dollar for political reasons, or do you think this is a way to hedge themselves against dollar risk, or both?
I mean, I think it's a bit of both. So basically, ever since the global financial crisis, you've seen, for decades, countries, for example, were decreasing their tonnage, their gold reserve tonnage, and increasing their dollar exposure in their central bank reserves. Starting in 2009, that trend reversed, where countries began reaccumulating gold. So they went from under 30,000 tons to something like 36,000 tons. They had it's like a V-shaped change. They were going down, and they started going up for 15 years now, 14 years. They've also, around the margins, you've seen the Chinese currency go from no exposure in reserves to a little bit of exposure in reserves. So it's grown quickly from a very, very tiny base. You also seen the euro lose general holding, while the U.S. dollar has been relatively stable. I think there's two sides to these headlines, and both extremes tend to, in my opinion, be wrong. So, there's a lot of headlines around threatening dollar reserve status. There's a lot of headlines around these alternative things. And there's been a long history of this. There's been decades of countries trying to make currency alliances, things like that. And so, a lot of people jump on the hype train. And I think that's in some ways overstated. On the other hand, I think it's a mistake for people that just dismiss this and say, "Oh, it's been happening for decades. It's never going to happen. Don't worry about it," because obviously things have changed, right? This isn't 2004. This isn't 2012. Back then China was way smaller than the United States. Now, in many measures, it's larger than the United States. So the biggest trading partner with the majority of countries now. We froze Russia's reserves, and so we've kind of pushed Russia and China closer together. Saudi Arabia's relationship with the United States has cooled, while their relationship east has improved. And so we've seen a number of headlines, which is basically Saudi's cozying up to China a little bit. Brazil and China just made some deals to kind of exchange their currency more directly. We have China having a better prospect of being able to buy commodities and energy in its own currency. And so I think the general trend shift is that we're going towards a more multipolar world which makes sense because there was this like 30-year period from the early 90s, like the fall of the Soviet Union, until a handful of years ago, where we were in a very unipolar world. There's the United States and everything else built around it, and now, which is the more natural state of affairs, you have a handful of different regional powers. So China's economy is comparable to the United States now. It's higher in some ways, it's lower in other ways. You also have, the Eurozone is a big block. You have a couple other regional powers like India, Brazil, Russia, obviously. You have these kind of regional powers, and that's the world we currently live in. So unless something devastating happens to China or some of these countries, I think the trend is towards a more polar world for both payment systems, so the countries are protected against getting cut off from the dollar, as well as reserve diversification, so that they don't have 100% of their reserves or 60% of their reserves fully exposed to the dollar and either inflation risk or seizure risk.
That multipolar world, do you think we're at a stage where we should be considering that Bitcoin is a relevant part of that? It's kind of more of a decentralized, permissionless alternative, but it is an alternative to individuals, nation states.
So I think it's on the horizon, but it's still early because Bitcoin's not big and liquid enough for that scale yet. I mean, right now we're still at the stage where large individuals can move the price, let alone countries moving the price. And so I think it's one of those things like Bitcoin kind of needs another zero on its liquidity and its market cap in order to be relevant at that scale. Right now, it's really about gold, dollars, and yuan, kind of, and just these alternate payment systems, and less so about Bitcoin. But obviously, the potential for Bitcoin is huge, and certainly you must have countries looking at it. Russia's mentioned it. The number of countries have clearly looked at it.
Are you following the choke point drama related to all of this? The various banks cutting people off. We've had some in the UK. We've seen some in the US. Some people raising suspicions of what happened with some of the banks is part of the choke point. How real do you think that is?
I think there's a lot of truth to it. I think the people that are covering it are asking the right questions, right? So, for example, with say, one of the banks, like Signature, for example, when that bank was closed, and now their network, their crypto network's up for sale now, and the FDIC is supposed to get maximum recovery for deposit holders and for taxpayers now, and that they're not willing to sell that, it seems. Right. I think there's interesting questions that should be asked to hold them to account. And unfortunately, this goes back to the 1940s, which is, I guess we can back. So if you look at the 70s, right, if you have very high inflation because of excessive bank lending, the central bank can tighten a lot and slow that down because debts are very low. You can just say, okay, everything's tighter now, super high interest rates, and that will curtail lending. The problem is if you have a 1940s environment where the sovereign itself is very, very highly indebted, there's tons of debt in the system. They have trouble raising interest rates super high because in addition to causing all these bank problems, it also compounds into causing more and more fiscal deficits that have to be monetized. And so what they generally do in that environment is they're less likely to raise interest rates super high the way like Volcker did. And instead they keep interest rates low or moderate while then also doing capital controls or lending controls to prevent lenders from taking advantage of those negative real rates. And you see that, for example, in Turkey today. They say, okay, if you're a corporation, you can't borrow lira and buy foreign currency with it, right? Because otherwise, why wouldn't you? Their interest rates are not high enough to compensate you for lira inflation. There's a good incentive to borrow lira and buy almost anything else. And so they try to restrict that type of speculative attack on their currency. You've also seen Nigeria, for example, they've cut off their banking system to crypto exchanges. And so I think around the margin, that is one of the defenses that these countries turn to. And I think in developed markets, we are seeing early signs of that, basically that they're clamping down around the margins where they can and where they think they have cover to do so.
And do you think that, like, a lot of people would point the finger up and say, well, this is all about control, and it feels that sometimes it's actually more about protecting their system, and I know they're kind of the same thing, but it is a slight difference. It's not just so much like, oh, we don't like Bitcoin, it's bad, he's just using it, we want to be able to control you. It's that actually if there is a flight to safety into Bitcoin, it could destroy the whole system in terms of trying to protect stability of their system, that might be a reason to choke out Bitcoin.
I think from their perspective, yes. I mean, basically, if a country mismanages its ledger or has to do things that are not popular, that's where they turn to controls. And so in the United States, for example, during World War II, I mean, during the 30s, even before World War II, and continued until the 1970s, it was illegal for Americans to own gold. So 40 years couldn't own gold. And the reason for that essentially was the U.S. ledger was being inflated, and they had to try to ban alternative ledgers. They say, well, you can't use gold as your savings. You have to use a dollar, and you have to sit there and earn negative real yields for like a decade. And if you don't want to, then tough luck. And it's funny because the United States, so mostly they only ban upwards, right? So for example, the United States was basically with maybe Switzerland aside, but basically Swiss and the United States were like the two strongest currency systems you could be in during that period. So the only thing the United States had to worry about was gold. Didn't have to worry about people wanting to go into like French currency because they were getting wrecked, even more. And so they only had to ban upwards. Similar today, Argentina will freak out and try to prevent people from getting into dollars too quickly. Whereas the United States is not worried about people going into Argentine pesos too quickly. Nigeria is worried about people going into dollars. They're worried about people going into Bitcoin and stable coins and things like that. So yeah, basically it's these ledgers turn to protective measures when their own system is weak and they want to try to prevent flight into something stronger.